Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management, and we are certainly grateful that you're able to join us this week. We know the long weekend is right around the corner, and for many of us, we already have one foot out the door, and we certainly don't want to be the impediment to your long weekend. So we're going to go ahead and we're going to keep it short and to the point this week. The bottom line, ladies and gentlemen, is that at the end of the day, part of investing is all about money flow. And what we're really trying to do is understand where in the market money's flowing to. Is it continuing to flow to that area, or are there going to be broader shifts that are taking place? Bottom line message here, broader shifts are starting to take place. We've seen that with how markets have moved over the last couple of weeks, especially in the last couple of days. You've seen a reacceleration and confirmation of our message of that move away from technology and toward other areas of the market. And what we're seeing in particular is that whether it's price data through the PCE, personal consumption and expenditure data, or whether it's through durable goods, or whether it's through unemployment claims, all of that data is suggestive of one thing: a stronger US economy, and also some modest price pressures. When we combine those two facts together, what it's really leading us to come to that conclusion is that 10-year US interest rates are on their move toward 2%. US dollar is starting to break down relative to the euro, relative to the yen. Very, very important point. And of course, all of this is good for commodities, good for banks, good for industrials. When the US dollar breaks down, you buy commodities, you buy the banks, you buy industrials. It's as simple as that. Why? Because US dollar commodities are priced in US dollars. Banks make more money when the yield curve steepens, and industrials do well because US products are priced in US dollars. So overseas, US products become more attractive and more competitive. Number two, the VIX is busted. Just buy the damn dip, ladies and gentlemen. When volatility breaks support, it forces pension funds, mutual funds, hedge funds, all of their models that drive their asset allocation, basically signal the market is green and force them to increase exposure to the stock market. It's that simple. That's how these models work. And so what we want to do is front run that data. We know that's going to happen to a large degree. Sometimes we're wrong, but largely that's what happens in the broader Wall Street industry. And so what we want to do is front run that data, buy the dip. Third, multiple compression is starting to reaccelerate within technology. This means that valuations are becoming a sustained headwind, especially as those 10-year interest rates move higher. When 10-year interest rates move higher, I want to pay less for growth 10 years from now. That is a big structural headwind on high growth stocks within technology, high growth in general, but in particular, we see that centered in technology. And then lastly, when European rates move higher, that pushes US rates higher. So we want to front run that data again and drive our asset allocation toward asset classes that benefit from higher US rates, such as commodities, banks, and industrials. I can get this old slide here to move over. We'll continue. Number two, the great reopening continues. We see here cases are down to 12,000. This is all the way going all the way, the lowest count all the way back to March of 2020. The message is simple. Look at the case count. Doesn't matter why it's happening. Just look at the case count. Look at the air traffic activity, almost back to pre-pandemic highs. These two factors say one message: the US economy is recovering. The US economy is strong, and people are underestimating the sustainability of the overall recovery by the market. We talked a little bit about negative rates in Europe and how that's ultimately impacting US rates. What we see here, ladies and gentlemen, is just at the beginning of the year, January 1st, December 31st, 2020, almost all of Europe had negative interest rates. Now, only Germany and Switzerland have negative interest rates. What this means is if you're a bond portfolio manager in Europe, you were dealing with negative interest rates. You had to figure out a way to generate return for your investors. So what did you do? You went and bought US paper that was positive yielding. Hey, plus 0.6% looks pretty good compared to negative 0.6%, right? So as European rates move higher, the relative attraction of US paper starts to shrink. And so European investors, Japanese investors start to sell that US paper because when you compare the higher rates in Europe, even though they're still lower than the US, plus the cost to hedge the currency exposure, the relative benefit of owning that US paper almost evaporates. And so as European rates go higher, it's acting as a rising tide on interest rates across the entire globe, especially the US. Again, what happens when interest rates move higher, ladies and gentlemen? We want to buy the banks in a positive sloping yield curve environment. And if it's combined with a lower US dollar, we want to buy commodities and we want to buy industrials. Very important points. Now, within tech, we know for a long time that tech has been the market leader, the market darling. We have been huge beneficiaries of that. We were up 101% last year because of our overweight in technology. But like all dominant trends, ladies and gentlemen, they have a birth, they have a life, and it has an end, right? And so a birth, a peak, and an end. And what we want to pay attention to is the end in this case. The S&P 500 in 2008 was, the technology sector within the S&P was about 19% of the S&P 500 in 2008. Now it's 37%. You can easily spot where the flow of funds has bubbled into, right? At the peak in 2001, during the internet bubble, technology reached, guess what? 40% of the S&P 500. And then ultimately, those valuations became a headwind. Those flow funds moved into other areas of the market, and so started the commodity super cycle from 2000 to 2011. This time around, tech is 37% of the S&P 500. Energy has shrank from 13 to 3%. In fact, 2.5% to be specific. So the question is, as technology peaks out, assuming it is peaking out, where will this money go? And that's how we want to position the portfolios over the next few years, is to be sitting here and receiving the flow of funds in the assets that we are positioned in. Now, sometimes that transition's a little messy, as the last month has been, but that's what pays long-term dividends for our investors. That's how we ultimately generated outperformance over the last 10 years, and how we want to continue to generate outperformance, if we are correct, over the next 5 to 10 years. We can see here, technology, quite simple. Look at the chart, upward and to the right, unabated pretty much for the last 10 years. In fact, we've gone from 20 on the XLK all the way to past 140. Now we have this big head and shoulders top on a weekly chart basis, and very, very, very wide price to sales multiple. So when people tell us, hey, you know what, tech's already sold off, buy the dip, how much lower can it go? Why just pull up this chart? It can go a lot lower. We've only gone back down to November levels. Very important. We can go much further down if our thesis is correct. Meanwhile, in energy, we're about 60% off our highs, right? So actually about 50% off the highs. Energy's been in a 10-year bear market. The fundamentals are improving. We're using more oil and gas than ever before. And there's a structural shortage of supply response to improving demand, thanks to low permitting approvals here in the US. So all of those factors combined tell us no one owns energy, 2.5%. It is improving fundamentally, and it's cheap. Those are the prime ingredients for the beginning stages of a new dominant market cycle. Then we look at the relative strength of technology. Notice here, this is the NASDAQ in 2000, and these are the ARK funds. The ARK funds are at the center of what we call the most speculative areas within technology. What we see here is the initial sell-off, an attempt to rally, and then the next big and more painful down cycle in the ultimate bubble unwind. This is what we want to avoid for investors. That's why we're 0% technology right now. And when we look at the technology sector in the S&P 500, what we see here is the price data has obviously come down, but the relative strength has massively rolled over. In other words, technology relative to the S&P 500 has put in a very large top. This is very, very concerning for us and something that we don't want to be around to see if whether or not it comes back or not. When we see this type of action, we move to the sidelines. Asset protection first, asset growth second. Very important. Also flagging at the individual stock level. We know that Netflix and Apple have been very dominant stocks within technology and within communications. And we see the same thing playing out. We see that the price data has flagged, we've not been able to make new highs, and the relative strength is rolling over for both of these market darlings. Again, very consensus, almost everyone owns it. We want to be off to the sidelines, and we want to invest where others aren't, right? Every party has a beginning, a peak, and an end. And we like to get to the party, we don't want to be the first to the party, we want to be early to the party. We want to let others test out to see whether that party is any good. Within energy's put in some higher lows. No one owns it. We're in the first or second inning of this cycle. And you can see that here. Almost no one owns energy. This is the amount of people that own energy over time. We're near all-time lows, but we've still seen that technical data improve. We've put in those higher lows. And you can see here again, energy, mutual fund and hedge fund ownership relative to the S&P 500 at near all-time lows as well. And then, of course, oil's acting resilient. We know all the negative headlines around Iran and the supply that'll come on with that Iran deal. Please, let's get this deal done because it's not going to really affect supply and demand. If you want to know how oil is going to do, tell me how much oil the US consumer and the European consumer and, of course, China are going to consume. And that's ultimately going to drive the price. Obviously, supply is important, but the US is that swing producer, and we're not seeing a whole lot of supply response out of the US right now. So that is positive for the price of oil. And the fact that we're going up against these negative headlines is something that is very technically bullish. It's called climbing a wall of worry, something we want to see. Would most people believe that the price of oil now is now up 3%, actually a little bit more after today, since the start of 2020, so since pre-pandemic. Meanwhile, XLE, the energy stocks, oil service stocks, they're both down 17 and 29%. We expect this to compress, and that'll be positive for the energy stocks. Very important points. And then, of course, lastly, the US dollar is beginning that generational breakdown. What did we say at the beginning? Keep it simple. US dollar breaks down, we want to be long oil, copper, steel, real estate, any sort of hard asset that will go up in price when US dollars go down, if they're priced in US dollars, of course. And then lastly, of course, I know I said lastly, this is truly lastly, the credit markets remain healthy. This underpins everything we do. If the credit markets start to deteriorate, throw everything else out the window. We go to cash, we play protection. Credit markets are incredibly healthy right now. This puts everything else in play and allows us to drive asset allocations into different areas of the market. So credit spreads remain low. That gives us the green light to invest in the market. So overall, ladies and gentlemen, the US dollar going down, we want to position in assets that benefit. Sell those rallies in technology. That is a bear trap according to our work, and buy those sell-offs in commodities, banks, industrials, etc. We've increased our financial weight as a result of the data that came out this week. And then lastly, that secular US dollar weakness is going to be a huge factor to drive asset flows across markets. So as usual, if you have any questions or concerns, please feel free to reach out to our offices here at 888-543-3776. Please reach out to your advisor if you have any questions, and have a fantastic long weekend. Thank you again. Happy Memorial Day, and we'll see you again next week.